Thanks so much, gentlemen, for taking time out and joining in. It's expiry, and then, of course, the big budget event coming up next week, and we're in the thick of earnings season. But, looking at the screen, Charandeep, it's a little bit disconcerting purely because of the fact that as we were talking this morning, the FIIs are on a relentless selling spree, whatever factors you attribute that to. Do you think that that's going to be a concern for us for quite some time, or do you think that the budget could be, that key trigger that could change the positioning?
Yeah. Good morning, Aban, and thanks for having us on the show this morning. I think there's 2 points that come to my mind when you mention the FI selling. See, it's very hard to pinpoint the exact factors, but one thing that does come to our mind is that interest rates have gone up globally. They've of course gone up a little bit in India. We don't here sitting in India realize the kind of damage there has been in growth stocks, high growth stocks and tech stocks globally. Portfolios are heavily damaged and people are hurting. And now after many, many years in the West, you can, for example, buy Microsoft investment grade bonds at 5%. And you can buy high yield bonds at 8, 9, 10%, right? Which is far higher than Indian high yield bonds yield. So it's a huge anomaly. Now imagine an FI sitting making allocation decisions and saying, what do I choose? It's a tough choice. You're spoiled for choices. It's a buyer's market, both on the equity side and on the debt side. India, on the other hand, also has the headwind of high multiples compared to its peers, right? But what's in favor, and we believe really in favor, is that you have very good earnings visibility, as is well known, and probably one of the isolated growing markets in the world with a great outlook. So I think that, there are pros and cons, but unfortunately, FIs don't think the way we do sitting in India. They've got their own agendas and their own macro factors to look at.
Okay, so now when we've actually established that, can I also ask you, what are the kind of big changes that we can expect in your portfolio, the changes that you have already made in anticipation?
I'm happy to take that question. Well, look, I think there's been a strong realization over the last 15 months at Girik's end, and I think the market's also adjusting to this, is that you had a lot of high growth, well, not necessarily high growth, but a very high multiple stocks that have done very well in the last 5-10 years. A lot of the consumer pack, a lot of the retail lenders, anything to do with the consumer had gotten very expensive. And you're seeing a bit of deflation of that trade right now. So I think one has to be very cautious in growth at any price, buy at any price, high growth companies, which used to trade at very high multiples, where the growth isn't actually that high. So whereas we are proponents of high growth style of investing, we believe even that has a price. The biggest driver of equity market returns is ultimately a low entry multiple when I'm talking at a stock specific level. So very important that you get the growth right, but you get the multiple right. I can tell you that we are seeing more opportunities than before. The IPO market has come to some level of normalcy. IPOs are now worth looking at again because they're not coming at crazy multiples. They're starting to come at more reasonable, fair multiples. Just because the overhang in the growth market, given the global dislocation, the opportunities are opening up. We made tremendous changes to our portfolios in the last 12 to 18 months. One more theme I think that I will leave you with is that there is a lot of sectors that were ignored over many years. Your capex oriented, construction oriented, manufacturing oriented, where there's a bit of a renaissance going on in India. Because they've been ignored for so long, the market caps are not very large compared to the size of the earnings growth that can come, assuming that manufacturing as a sector plays out well in India. So that's where we are leaning, and these are the sort of trends we are seeing.
I'm just looking at the declared portfolio, what we have. 5-star, it's an IPO. I would consider Zomato still, it's a recent listing, about a year plus. You've added Landmark Car, which is not even 3 months old, and Shirma SGX, which is about a year old. So I can see there are 4 IPOs which are part of your portfolio. Any reason why these 4 stocks have made it to your portfolio?
Yeah, I could take that. Hi Nikunj, very happy new year to you and the entire ET Now team. So, we've always been very, very excited to look at IPOs. We think IPOs can deliver massive value, provided they've bought at reasonable multiples, and the growth is intact. Uh, you know, we even in the past, many times IPOs are not well understood when they list, and over time, people understand them, and allocations and money flow do start coming in. So, what we've learned is that the first few years after a company's IPOing are probably one of the best times for their stock prices and businesses, even for their businesses' growth. So, and each of these companies are on in different sectors, but we feel that the growth would be pretty solid, run by good promoters, good management, and we generally are always in the lookout for good IPOs.
Be specific here. What is that you like about Landmark? What is that you like about Five Star? Why are these two stocks are part of your portfolio? Five Star, based on what the industry average is, based on price to book, not really cheap. Landmark, niche, but it's a business which some would say is difficult to value.
Yeah, that's true. If you look at Landmark, I don't think many people have understood that business. What we liked was the service part of it. I think one theme which we really felt was interesting in the Indian auto market is that the whole industry is moving towards higher end auto cars. So people want to buy more expensive cars rather than the cheap ones. We've seen that with many companies like SUVs are getting sold more than the entry level cars, and I think Landmark plays in that bracket, where it's selling more expensive cars. It's not in the entry level cars. All the dealership it has is cars above 10 lakhs. So one is that. The other is that there is a big element of service revenue, which we felt is very, very sticky, and we felt it's a long tail. One could play it for the next 5-10 years. And again, one thing which we are very, very cautious about in these markets is the starting multiple. The starting multiple needs to be in your favor, and we felt it was in our favor here. And the other one is Five Star. Yes, Five Star is probably not the cheapest, but you know, I think we feel that the growth is very exciting. The history is very good, and we'll see how it plays out. But I think they've done a great job to come where they are through COVID.
Varun, I think you were making a point on Five Star. It's expensive, but yet you like it. I mean, isn't that against the grain? Because Charanjeet just said that you go to buy stocks when they're cheap. So why are you confident of making money in Five Star even though it is not cheap?
Yes, I think valid point, and that's why we start with a very small allocation, and when we see how it goes. But I think the general philosophy here is that we feel the growth will be very, very strong, and we still need to see how it plays out. But we like the execution, we like the management, the way they came through COVID was very good. But yes, we are very cautious of starting high multiples because we can see that market's not rewarding uh, growth at any multiple. So one needs to be careful for sure.
Right. Charanjit, I also see that you're sitting on almost 18% cash levels. Is that a conscious call? Is it just for scouting newer opportunities, or are you also, sort of a little wary about what the budget is going to do on LTCG?
Yeah, no, that's not the case for us. I don't think it's as high as 18%. It may be maybe less than that. But in general, we're not market timers as such. And, we're opportunistic as to the stocks we have. And if entry points emerge in our stock, or if we have a reason to increase allocation in something or find something new, we'll deploy the cash. So we are always looking to be fully deployed. We're not trying to time based on events that we don't do well and we don't try to do.